Hello and welcome to Mint Wide Angle. I'm Anindya Chakravarti and today I'm going to dissect that worrying bit of data that came out a couple of days ago. That's the Q2 GDP number, which is virtually collapsed, just 4.5% GDP growth between July to September 2019-20 compared to the same period last year. That's the second lowest number that we've had in the new series of GDP, the lowest since 2013 when the UPA was accused of policy paralysis and then it was booted out by voters. To understand what these GDP numbers mean, we're going to take a look at the three core pillars of any economy. What are they? Investment, jobs and consumption. Why do we call these the three pillars? Because when there's more investment, what happens? More jobs are created. When more jobs are created, people buy more things, demand goes up, and businesses are more confident about investing more, expanding. So what happens? That's a virtuous cycle. Investment, jobs, more demand, more consumption, and more investment. There's one particular number in GDP data which tells us what investment in the economy is like, and that's called gross fixed capital formation. A bit of a technical term, but what is it really? Fixed capital means new machines, new factories, restaurants, hotels that have been put out, offices that have been built. When it comes to agriculture, you talk about new agricultural equipment, livestock, which includes cattle, poultry, and of course, when it comes to trade, you don't have anything new, so you look at bank advances. How much has this fixed capital formation gone up by? Just 1%. Just 1%, and it's come on the back of just a 4% growth in the previous quarter. What does that tell you? It tells you that there is virtually no investment appetite in the economy right now, and that is despite the fact that the RBI has continuously reduced interest rates. So even cutting interest rates is not inducing corporates to invest more. Now let's look at jobs. Obviously, if there's no investment, we are not likely to see much job growth either. There's no direct data available in the GDP figures there for us to know how many jobs have been created, but there's a way to get a sense of what's happening by looking at some of the key job creating sectors. What are they? CMI tells us that agriculture is the biggest employer in India. It employs about 35% of people, and that includes animal husbandry, which is poultry farming, dairy, and other things like that. Now, what is the second biggest? It includes retail and wholesale trade. There is communications, there's transport involved in it, and there is the hotels and the vendors and hawkers that you look at. So that overall space is about 30-odd%. Other than that, a big employer is construction, which accounts for about 15% of all employment. And finally, another big employer is manufacturing, which is about 10%. So these are the four key sectors, and we get some data about that in the GDP numbers. Let's look at them one by one. Agriculture, which grew at about 5% in Q2 last year, has grown by just 2.1%. And that's coming on the back of a pretty dismal growth of just 2% in the first quarter of this fiscal. Trade, hotels, transport and communication, that's grown by just 4.8%, and that's down from 7.1% in the previous quarter. Construction, which employs about 15% of India's working population, has grown by just 3.3%. That's compared to a relatively decent growth in the first quarter of 5.7%. Nothing great, but still not bad, and more than 8% in Q2 last year. So if you compare to Q2 last year and the previous quarter, we're seeing a downslide in construction as well. And finally, manufacturing, which is the fourth biggest sector when it comes to providing jobs. That is down. There's been a contraction of 1% this quarter. And if you take the previous quarter where the growth was a measly 0.6% and add the two, which is basically you get the first 6 months, then manufacturing growth is down 0.2%. Compare that to last year when in the first 6 months manufacturing grew by almost 10%. So you can see what's happening in that manufacturing sector. There might not be a recession elsewhere, it might just be a slowdown, but there is a recession in manufacturing. So this tells you that the top 4 job creating sectors in the economy have either slowed down drastically or has gone into a recession, which is manufacturing, and that tells you that there is very little chance of real jobs having been created in the economy in the second quarter. So this now brings us to the final pillar of the economy, the third pillar, which is consumption. There are two parts to this. One is private consumption, which is largely by households like ours, and then there is government consumption. 80%, a little more than that actually, is private consumption expenditure, and a little less than 20% is government final consumption expenditure. What has happened to private consumption? It has actually slowed down significantly. Growth there is just about 5%. Compare that to what it was in Q2 last year. Their growth had been almost 10%. But when we come to government consumption, that has actually grown handsomely. More than 15% growth in government final consumption expenditure in Q2 of this fiscal, and that comes on the top of 11% growth in Q2 of the previous fiscal. So the base was high, and on top of that there's been high growth. So there's been a lot of expenditure from the government. So it looks like government consumption is driving GDP growth right now. In fact, if you take it out, private demand has grown just by 3.1% in Q2. That is the lowest in the new series, even lower than the policy paralysis days of the UPA. So what can the government really do in this kind of a situation? Because there's no appetite for private investment. You already saw that gross fixed capital formation, which by the way includes investment by the government, has grown by a measly 1%. The government did cut corporate taxes. What happened? There has been some amount of profit growth for companies which were bleeding, but overall listed companies have shown just a 0.3% growth in profit in Q2 of this fiscal. And if you remove the financial companies, then what do you have? You have a 20% drop in profit for non-finance listed companies in the September quarter. So even corporate tax, low interest rates is not really helping revive the corporate sector. Given that private sector is unlikely to invest, and given that private consumption is unlikely to revive very quickly, only the government can actually spend right now and give a boost to the economy. That's the only way out. Unfortunately, the FRBM Act restricts the government, but there is a bit of a leeway to increase government expenditure. The government has been spending a lot, but it has been spending on consumption. What it has to do is spend on capital investments and invest more. This 1% growth in gross fixed capital formation is a danger sign. The government needs to invest there, increase its capital layout, because the economy right now needs a steroid booster. It needs that steroid injection. Yes, steroids are dangerous to patients sometimes, but when the patient is about to die, sometimes that's the only option available.